Today, I'm going to show you how you can actually spot a trend reversal before it even happens. But first, let me ask you this. Have you ever felt like the market was playing a cruel joke on you? You see a perfect trend, you enter a trade, and the moment you do, the entire market just flips and takes your money. It's a gut punch every single time. I've been there. I know that frustration. But what if I told you that those sudden U-turns aren't random? What if you could actually see the signs, the early warnings, right before a trend is about to crash? In this video, I'm going to show you exactly how to do that. We're breaking down the hidden clues that professional traders look for to spot a trend reversal before it even happens. So if you're tired of being on the wrong side of the market, stick around. This is the one video that might just change the way you trade forever. So, what is a reversal? A reversal is simply a change in the trend's direction. Like here, we've got a clear uptrend, but then price flips around and starts forming a downtrend. That's a reversal. Now here's where most traders get it wrong. They assume just because price is too high, it has to reverse. But that's the trap. If price is still climbing, the momentum is still strong. And shorting it blindly just because it's gone up too much means you're fighting the trend. And you know what they say, the trend is your friend until it ends. So let's break down some practical ways you can actually spot when that end might be coming. The first one is called the break of structure, and here's how it works. Step 1. To spot a potential reversal, you first need to identify the existing trend. In this chart, we can clearly see an uptrend. Notice how price is forming higher highs and respecting the levels underneath. That means we can also draw a rising trend line below it. Now here's the key. As long as price is still holding above that trend line, the uptrend is valid. So, to spot a reversal, price needs to break below the trend line. Here we can see price breaking the trend line. But be careful. Just because the trend line is broken doesn't automatically mean a full reversal. Even though the short-term move is down, the higher time frame is still up, meaning price still has a chance to climb again. So, to confirm it's not just a fake break, we need signs that price is losing bullish momentum. Notice how price tries to push back up, but fails. It tries again, fails a second time, and finally forms a double top pattern. This shows that buyers don't have enough strength to push the market higher anymore. So now we've got multiple reversal signals. First, a trend line break, which shows the structure is broken, and second, a double top, which shows momentum is fading. Put together, that's a strong case for a trend reversal. This becomes a solid sell opportunity. Of course, no strategy is 100% accurate, so we need to prepare our exit. Place your stop loss near the key level just above the double top, and set your target profit at a 1-to-2 risk to reward ratio. And as you can see, this trade hits profit. Now let's look at another variation of this technique. In this chart, we see another clear uptrend. Price is forming higher highs, and we've got multiple rejection points below where we can draw an ascending trend line. Next, price fails to make a new higher high. Instead, it creates a lower high, while also breaking below the trend line. That's the first warning sign. Buyers are losing control, and sellers are starting to push back. But again, don't jump into a position just yet, because the overall trend is still up. We need more confirmation. And here it comes. Price tries to push up again, but fails. Now it's starting to form lower highs and lower lows, which confirms we're in a new downtrend. Let's recap. First, we saw an uptrend losing momentum when price failed to make higher highs. Next, the trend line was broken, so the structure is now damaged. Finally, price then started making lower highs and lower lows, which confirms a downtrend. All of these factors together confirm that the trend has officially reversed. This is another great opportunity to sell. For the exit strategy, stop loss goes near the closest key level and target profit at a 1-to-2 risk to reward. And once again, this trade finishes in profit. What I just showed you is one way to catch a reversal when price breaks a level. But remember, markets don't always behave like this. Sometimes, price doesn't break. Instead, it rejects and bounces from a key level. That brings us to the second technique, reversals using key levels. Step 1. Identify a key level where price has reacted before. In this case, we can see a resistance level where price went up, rejected, and turned back down. Step 2. Wait for price to return to that same key level. Here, we see the uptrend pushing into resistance again. But you can't just assume it will reverse just because it touched the level. Price can always break through, so we need extra confirmation. This is where the stochastic indicator helps. Go to your indicators, search for stochastic, and apply it to your chart. Leave the default settings. Now, what we want is simple. Price reaching the key level while stochastic is showing overbought or oversold. Here's an example. Price is testing resistance while stochastic is overbought. But still, that doesn't mean we short immediately, because it could still break. The real confirmation comes when stochastic crosses back down below the overbought line. Once that happens, we have the green light to take a sell. For safety, your stop loss goes just above the key level, and your target profit is set at 2 times the stop loss distance. And as you can see, another profitable trade. Now let's move on to the third strategy, using trend indicators, specifically the exponential moving average, or EMA. Step 1. Add 2 EMAs to your chart. Set the first to a period of 10 and the second to a period of 20. Reading them is simple. When the EMA 10 crosses above the EMA 20, it signals an uptrend. And when the EMA 10 crosses below the EMA 20, that indicates a downtrend. But here's the thing. We're not going to take trades purely off the cross, because in choppy conditions, you'll get a lot of false signals. Instead, we'll use this as a confirmation tool around key levels. Here's how. First, identify a key level where the price has previously reacted. In this chart, we have a clear resistance level where the price touched it, then dropped back down. Now we wait for the price to approach that same key level again. When it does, watch the EMAs. If the EMA 10 crosses below the EMA 20, right at that key level, that confirms momentum has shifted bearish. That's your signal to sell. For your exits, place your stop loss just above the EMA cross and set your target profit at a 1-to-2 risk to reward ratio. And as you can see, once again, this ends in profit. So there you have it. 3 powerful ways to spot a reversal before it actually happens. We started with the break of structure, where the trend line break combined with a double top gave us that early warning sign. Then we looked at key levels with stochastic confirmation, a great way to avoid false signals and only enter when momentum truly shifts. And finally, we used the EMA confirmation method, a simple but effective tool to back up what price action is already showing us. The big takeaway here is this: reversals aren't random. If you know what to look for, the market actually leaves plenty of clues. The trick is to stay patient, wait for confirmation, and only pull the trigger when multiple signals line up. If you found this breakdown useful, drop a like to support the channel, and let me know in the comments which of these strategies you're going to try first. Alright traders, I'll see you in the next one. And as always, trade smart, stay safe.